and welcome, folks, to Almus Market Mornings, your daily dose of global financial updates. And welcome back for this weekend, after the weekend as well. And what do we have in the updates over here is the first ever default by Russia in foreign debt since 1918. Now, that's quite a long period of time. So, interesting news update from the war-stricken zones, while there has been also some updates on the metal pricing as well as the equity markets still continuing to do well. So JK, I'd like you to tell us exactly what's going on in the financial markets.
Hi, good morning, and start off the new week probably on a positive note. Nowadays, bad news is good news for the markets, and that's what happened in US markets. In fact, most of the global markets last week, when a series of poor economic data from US, ending with Michigan consumer sentiment final reading, all came quite weak, giving rise to more fears that consumer spending and economic activity may be slowing down going forward, and therefore the rate hikes will not happen at the same pace as was being predicted earlier. Markets took it that recession is on the cards. Definitely, of course, Powell also said that with financial conditions tightening, recession is not avoidable. So that led to good rally in stock market on Friday. Of course, the markets were already a bit oversold, and there were some technical indicators like divergences which were prompting traders to go long, and all of that together led to nearly 3% rally in S&P 500, which is the biggest one-day percentage rise since 2020. While most markets, including US and Europe and even in Asia today, have risen, some of the problems are not actually ending, particularly for Europe. It may be heading into the next phase of the energy crisis. Germany is heading for a gas shortage as Russian gas supplies remain low, and certain industries would have been shut down if there are no enough by the winter. So rising gas prices in Europe, PMI survey, and a broader cost of living squeeze is fanning fears of a recession, definitely in Europe. The two-year yield Germany fell by around 30 basis points, and Italy's two-year fell by about 21 basis points. The net effect is to increase the differential with US for the third consecutive week. At the same time, we have the G7 meeting going on, which started on the Saturday and goes into Monday. And some of the important decisions are being taken, or rather being discussed in this meeting. Just for people who may not be aware, G7 consists of 7 of the world's richest countries, including USA, UK, Canada, France, Germany, Italy, and Japan. They also invite other nations, including EU members. And this time, India is also one of the invitees, where PM Modi is attending. A major focus of this year's meeting is on economic shocks that have followed Russia's invasion of Ukraine and the subsequent Western sanctions, areas where experts believe finding a unified approach will be an easier task. Of greater interest to the financial markets would be the discussion on Iran nuclear deal, which some feel will be progressed in this meeting. So it is Europe and US have to come on the same page, and if that's so, then there may be weeks away from signing a deal, and that may be giving some more relief to the oil price. Oil prices are already given a good fall from around 123 to 110 in the last 10 days, and we are probably heading into the first negative oil price monthly close after several months. On the dollar, markets have been reacting to the fall in commodity prices and starting to reprice the Fed rate hikes to some extent. Fed fund futures on Friday priced in 73% possibility of a 75 basis point increase in July. But for September, market has actually factored in only 50 basis point rise as against 75, which was being priced in earlier. As a result, some of the safe haven demand for dollars has come off. However, we are still seeing major currency pairs holding the ranges and seen far lower than the level seen before the Fed rate hike. Unless we see softening of the inflation, dollar will remain more attractive due to its yield advantage, while currencies of other countries with high import bill in oil will take time to recover. The key levels I would watch for the direction of the dollar index would be euro at 10650 on the upside and 450 on the downside. GBP at 125 on the upside and 121 on the lower side. Yen at 136 and 133.50 on the lower side. Any break of either side will give us the next direction for these currencies as well as the dollar index. Coming to rupee, there have been the developments in global market which would have ideally helped rupee to recover, like a sizable fall in commodity prices, fall in the yields, strong recovery in risk assets, and slightly weaker dollar against the majors. But India is facing multiple domestic and global challenges, and above all stands the high BOP deficit projected by most analysts now above 60 BO USD for this financial year. It really needs support constantly from RBI through intervention to keep up the rupee steady as the demand supply mismatch continues. Without their intervention, rupee slide can be fast and furious. But so far they have been active, as evident from the nearly 10 billion fall in their reserves for the 2 weeks ending 17 June 2022, as per data published on Friday. We need much more fall in the oil price, and more importantly, to sustain those lower levels rather than just being one-off fall and then rally back to get the market to sell dollars. Even then, resumption of capital flows remains the key for rupee to make any sort of meaningful gain. Instantly, a dubious news is that the foreigners holding of shares in Indian equity has fallen to a 5-year low, even after adjusting for the price increases. So that's where we stand as far as the rupee is concerned. Expect 78 to offer strong support. While the upside progress may be slow for now, with resistance at 78.30 and 78.50. So that's it for me for the start of the week. So have a nice week. Go ahead.
Okay, JK, thank you so much. And I really like your start wherein you mentioned nowadays bad news are the good news. And why not, if we have to look at the way equity markets steered, the fact that central banks are now saying recessions can be unavoidable. So it's something different which we are seeing in the financial markets. But good to hear from you on those lines. Another updates I'd like to reiterate is the talks on the Iran nuclear deal, which can also push the oil prices in a directional move. Uh, After quite a while, we've started hearing this again. And on the domestic front, the 16 billion of BOP, it's quite significant. And no wonder we have seen such depreciation in rupee. So, folks, there's a lot of things going on. We'll keep updating you on the events and the data releases from the financial markets. Meanwhile, you can continue to manage your risk. We'll come back again tomorrow. Thank you so much for joining.